Hello students, in this video we will start a new chapter which is just related to the financial statement with adjustment. This is the part in which we discuss about the theoretical part of adjustments, and each and every adjustment is discussed in this video, so it is very important to you to first understand the adjustments. So let's start. First of all, final accounts are prepared to achieve the objective of accountancy. A businessman is entrusted to know the final result of the business, whether he has earned profit or loss. As you know, financial statement is prepared to know the financial position of the company, and in the particular amount, accounting period, amounting whatever it is, so it is calculated for the purpose of knowing the net profit. The businessman prepares a certain financial statement at the end of accounting period in order to know the profit and loss. Meaning of adjustments: those transactions which is related to accounting period for which the financial statements are being prepared but are not included in the trail balance because there is transaction not had been recorded in the books of accounts are called adjustments. In addition to it, those transactions which have been recorded in the books of account but they don't related to accounting period for which account are prepared, so it is called adjustments. So both of the aspects is to be considered whether it is included in the this financial accounting period or in the whether another financial accounting period. According to this, you have to prepare the final accounts with adjustments. The list of some important adjustments are outstanding expenses. Outstanding expenses are those expenses which is due but not paid. Prepaid expenses are those expenses which is paid before the due date. Accrued income, the income which is to become or received in the accounting period but still not received. Accrued, and income received in advance. Closing stock, depreciation, interest on capital, whether whatever amount you invested in the company or any business get some interest. Drawing, interest on drawing, and bad debts to be written off. Provision for bad debts, provision for discount on debtors, good withdrawn for domestic use, opening stock, and good use in the business as a free sample, charity or gift. Important adjustments are going to be discussed here from, and the certain expenses relating to the particular may be not have been paid in the accounting period. It's called outstanding expenses. All such expenses which are due for the payment in the one accounting year but actually paid in the future accounting year or payment of which postponed are called outstanding or unpaid expenses. Okay, all such expenses must be accounted for in the year in which they are incurred and irrespective to the fact whether it is paid or not. Okay, so this is the outstanding expenses. Now, prepaid expenses are the benefit of some of the expenses already spent will be available in the next accounting year also. Such portion of expenses called prepaid expenses. Since such expenses are already paid, they are also recorded in the books of account for the particular period to which they do not relate. The results shown by the final account of the particular period will not be correct because such expenses related to the future period. Therefore, such prepaid expenses must be adjusted in the books of account to arrive at the true profit, like insurance, taxes, telephone, rent paid in advance, and thus requiring the adjustments. So here is the example for your better understanding. Rent paid by X for the 1 year on 1st 7/09/2009 when his accounting year is calendar. Because it applied in the calendar year, the business is making financial statement according to calendar year. Calendar year here means from 1st January to 31st December. Thus, rent for 6 months will be remaining unexhausted and will be carried to the next year. So, the adjusting entry and treatment will be P&L account. To rent 4,000 and prepaid 100 will be less. And in balance sheet, it is shown as a prepaid rent in the asset side. Accrued income. There may be certain income which have been earned during the year but not yet received till the year end. Income like interest on investment, rent, commission, etc. are normally earned by the merchants during the particular accounting period but actually not received during the period. Such income items need adjusted or adjustment before the preparation of final account, and such income should be credited to the income account. At the same time, the income so earned but not received is an asset because the amount is still to be received. The adjustment entry will be under. In the P&L account, by commission, because commission is an income, and if there is some accrued commission will be add back, and in the asset side it is treated as a assets and written as a accrued commission. Okay, at the beginning of next year the above adjustment entry will be reserved under commission account to accrued commission. Okay, income received in advance. Sometimes trader receives certain amount during the particular trading period which are to be earned by the in future periods. Such income through the actual receive and therefore recorded not yet earned. Such income should be credited to the profit and loss account of the year in which they are earned. Therefore, such income through is not income but liability of the period. For example, in trial balance, Ram amount of commission credited as a 500. Adjustment commission received in advance will be less in a P&L account and will be written as a commission received in advance 100 because any advance income will be liability of the business. Okay, closing stock. It is represent the unsold stock at the end of the year. Generally, the closing stock does not appear inside the trial balance. That case it's shown in the credit side of trading account. But sometimes it appears inside the trial balance. It is not to be shown on the credit side of trading account but appear only in the balance sheet as an asset. Closing stock should be valued at the cost or market price whichever is the less. So you have to enter the closing stock in the balance sheet, and the whatever amount is the less, whether is the cost value or the market price, will be entered in the balance sheet. So journal entry will be closing stock account to trading account because it is transferred to the trading account, and the adjustment make is this closing stock. Okay, so it will be written as a closing stock, right? Okay, in trading account it is written in the credit side, and in balance sheet it is written in the asset side. Depreciation. The value of fixed asset diminish gradually with their use in the business. Although this diminution in the value happens every day, but accounting is done only at the end of accounting period, which is helpful for knowing the net profit of the business. So the adjustment will be depreciation in profit and loss account, and in the asset side of the balance sheet it is less from the furniture account. The entry may be passed through the preparation of trial balance, in what case depreciation amount will be appear in the trial balance itself. Also concerned asset will be appear in the reduced value since the amount of depreciation would be credited to it. In the case no further adjustment would be necessary, the depreciation will be debited to the profit and loss account like other expenses. Interest on capital. The proprietor may wish to ascertain his profit after considering the interest which he loses by investing his money in the firm. Interest to which is an expense for the business on one hand and income to the proprietor or on other hand. The following adjustment will be made. Interest on capital to capital. Interest on capital being an expense is debited to the profit and loss account, and same amount interest on capital is added to the capital. Okay, interest on capital reinvestment, and in P&L it is debited. Interest on drawing. As business allow interest on capital, it is also charged interest on drawing made by the proprietor. Interest so charged as income for the business on one hand and expense for the proprietor on other hand. The following entry will be capital account to interest on drawing. Interest on drawing being an income is to credit it to the profit and loss account and show as a deduction from the capital. Okay. Now, bad debts to the company. Bad debts to be written off. Bad debt is an irrecoverable debt from the customer during the course of financial year. These are recorded as a bad debt to the customer, particular customer name, and it is result in the reduction of customer debt balance and addition to the loss. Bad debts. At the end of the year, when the trial balance is drawn, there is two accounts shown, debit balance and the balance on sundry debtor account. Thus arrive at the net balance after deduction of any bad debt recovery during the year. But after all, the trial balance is prepared and before the final account is drawn, the trader may be fined that there is the addition of bad debts. Such bad debt must be recorded with the some adjustment entry given to the following effect of the final accounts. Profit and loss account, bad debts, and from debtors it will be less. If bad debt are appear inside the trial balance, these should not be deducted from the debtors in the balance sheet. In this case, the bad debts are only to be shown on the debit side of the profit and loss account. Provision for the discount on debtors. It is normal practice in the trade to allow the discount to the customer from prompt payment and constitute a substantial sum. Sometimes the goods are sold on the credit to the customer in the one accounting period where the payment is made by them in the next accounting period and the discount is to be allowed for them. It is the prudence policy to charge this expenses or expenditure to the period in which sales have been made. So the provision is created in the same manner as case in doubtful debts. So entry will be profit and loss account debit to the provision for discount on debtors. Opening stock. In case opening stock appear inside outside the trial balance, it is simple information and should not be taken as an adjustment. It means that the value of opening stock has been already adjusted in the purchase account, so it should not be taken into the adjustment. Sometimes trader, in order to surpass their profit, undervalue the stock, and in this case adjustment should be made. The value of surpassed should be added to the opening stock in the debit side of the trial balance and same amount should be added to the capital. Okay, capital, the liability side of the balance sheet, to effect to be above following adjustment is made. Opening stock debit to the capital. For example, Ram values his stock at 20% below cost. While preparing the final account, he decided to show the original cost at the account. So opening stock will be 4,000 and capital is 6,000. So opening stock will be 4,000 and additional 20%, that is 1,000. Okay, and in balance sheet, capital and the profit will be added to the capital. Okay, revaluation of opening stock. Goods used in the business. It is a kind of advertisement when the goods in which the trader deals are distributed among the customer as a free sample or publicity of the product. This results in the reduction of the stock of the trader. For giving the effect to the following adjustment entry is passed at the end of the year. Advertisement debit or charity or gift to purchase. Treatment. The cost of free sample goods is deducted from the purchase in the trading or debit side and the same amount should be debited in the profit and loss account. Okay, so this is the entry. Here video ends. If you have any doubt regarding any entry, you can ask me in your class and make short notes from this video to your notebook and complete all the chapter.